Good evening. My name is Jackie Knight. I'm the Corporate Training Director for STC, and I'm glad to have you with me this evening. Tonight's webinar is going to talk specifically about real estate investing in your self-directed IRA. But before we get started, I do need to just give you a couple of items of information about STC. We are a retirement plan administrator only, so we don't provide legal, tax, or investment advice for our clients. We also don't represent or sell any securities or investments of any kind, and I will be talking about some in detail tonight, but we don't actually sell them. We're not a registered investment advisor. And we don't represent or endorse any investment opportunities, even though I will be talking about some tonight. This is really for your informational purposes to help you determine what you might want to do with a self-directed IRA. So we do recommend that you consult with your legal, tax, and investment advisors prior to making any investments. So this evening's webinar is going to cover some basic information about self-directed retirement accounts. We're going to talk about the benefits of self-directing your retirement funds and the guidelines that must be followed in all retirement account investing. I'm going to give you some detailed information about what exactly STC offers our clients. And then we're going to go into the specifics of choosing and funding an investment for your account. We're going to talk specifically and in detail about purchasing real estate. We're going to cover a related topic on non-recourse loans, which will also lead into UBIT and UDFI, which I will define a little bit later. And then I will open the floor for your questions. So let's get started first with what we mean when we use that terminology, a self-directed retirement plan. What we mean is that you have a retirement plan, could be one of several different types, but you are working with an organization, a company, an entity that allows you to choose any type of asset that is allowable by law. So that would mean you could choose investments that some consider non-traditional, like real estate. Self-direction also means that you're going to manage those retirement plan investments. So let's say, for example, you decide to purchase inside your retirement account a property, and you decide to rehab that property and then hold it as a rental. You're going to make the decisions about the rehabs that you're going to make on that property. You're going to make the decisions related to tenants, rental rates you're going to charge, if you're going to put in a new washing machine. So you're going to be able to make the decisions that relate to the investments you hold in a self-directed account, meaning basically you have more control. So any type of asset that is allowed by the IRS or the Department of Labor for ERISA retirement accounts, any kind of thing that is permitted by law, a self-directed retirement plan would be permitted to own. So let's just talk a little bit about some of the basic retirement plans you might be familiar with or not. Traditional and Roth IRAs. Now, these are pretty common. A lot of people know about these. They permit you, both of them permit you to make contributions annually from your earned income. The amounts that you can contribute into these plans are identical. For 2023, from your earned income, you can contribute $6,500 into these plans. If you are 50 years or older, you can do what's called a catch-up contribution and add another $1,000 to that to make it a total of $7,500. The difference between these two plans, though, is significant. Contributions into a traditional IRA are made pre-tax. So that means, let's say you're going to contribute $6,500 into your traditional IRA, then you would not include those monies on your tax return for 2023. They're pre-tax. When you take a distribution from your traditional IRA, that is when those monies would be included in your taxable income. Roth, unlike that, is contributions are made post-tax. So now let's say you're going to make a $6,500 contribution into your Roth account. You can't deduct that from your taxable income for 2023. But the nice news is when you take distributions, qualified distributions from a Roth account, they are not included in your taxable income. So that means as you're making contributions into a Roth account and you're paying taxes on those contributions, but those monies inside of your account are earning. Hopefully they're earning a really nice rate. And when you begin taking distributions from this account, you'll also be taking distributions that include those earnings. So basically those earnings are tax-free if they're in a qualified distribution. So that's the difference between Roth contributions and distributions, is when do you pay the taxes, and can you have this tax-free earning potential in a Roth account? A SEP is a simplified employee pension plan. I've seen some small businesses have this type of plan, some sole proprietors. A SEP does give you the opportunity to make two different employer and employee contributions. So, for example, and much larger contributions, because the SEP is actually on a business. It could be a sole proprietor business or an incorporated business. So, for example, I have a SEP plan. I have some self-employed work. So from my self-employed earnings, I can make a contribution into my SEP plan. Now, the SEP maximum contribution for 2023 is $66,000. So I see it's quite more significant than what you can make into a traditional or a Roth IRA. A simple plan is a savings incentive match plan. The couple of people I know who have these were actually either sole proprietors or they were in partnerships. Has some different nuances to it. You can talk with your tax advisor about, which of these plans you might fit into and which would be best for you. The simple plan's annual contribution amount for 2023 is $15,500. Now, I brought out onto your screen 4 plans that all say former employer. So first, let me define them. A 401k is a for-profit corporate type of plan. 403b, oftentimes used by nonprofits or charitable organizations. TSA is a tax-sheltered annuity. TSP is a thrift savings plan. So these are different types of plans that an employer might offer employees. Now, if you formerly worked and participated in one of these types of plans and still have your money there, you can move that money out to a plan you qualify for now, say a traditional IRA, or perhaps you're in business now for yourself, perhaps a SEP. If you are currently employed and participating in one of these plans, then you will need to go to your employer's plan administrator and find out if you are eligible to move any monies out of that plan into another plan that you qualified for if you would like to self-direct some of those monies. Sometimes if you moved between companies and you moved from one 401k plan to another company's 401k plan, sometimes plan documents are written that you can actually take those monies out of the plan while you're still employed. So it just depends on your employer's administrative documents. So you will need to check out those if you are currently employed. But former employer, you can move those monies out of their plan into a plan that you currently qualify for. One last plan I'll mention briefly is a solo 401k plan, sometimes called a uni, or there are different names for it. But basically, it's a 401 plan for a sole proprietor. So it's not a corporation, it's actually a sole proprietor, someone that is in business for themselves, basically by themselves. There are some very specific requirements for this type of a plan, but it has some great benefits if you are a sole proprietor. You can have very limited employees. Your spouse can work with you in the business. You can write the plan documents to include a loan provision, which is sometimes very nice for a small business owner. You can also have a Roth provision in a solo 401k. So just some nice things if you are a sole proprietor and maybe haven't had anything but a traditional or a Roth or a SEP, you might want to look into something like a solo 401k for those benefits that are available to you. So just a little bit about some different types of retirement plans. And again, Self-direction, a self-directed plan is not a type of plan. It just means that you are working with a company. A company is holding your retirement plan who permits you to self-direct. So that's kind of the difference, the nuance in the terminology. So why do you want to self-direct? I mean, what's kind of in it for you? Well, a big thing is you can truly diversify your assets. It was a lot of companies that hold your retirement plans. You're pretty much limited to stocks, bonds, mutual funds, ETFs, those kinds of things. With a self-directed plan, you have the door open to lots of different assets like real estate, I've already mentioned, mortgages, notes, private business. We're actually going to go through a pretty complete list of things you can invest in, but it really does give you the opportunity to diversify into different asset classes so that they're not all tied, say, to the stock market, the economy, what's going on where. You might have a little bit more diversification than you would in another type of plan. In addition, I've already mentioned that you choose and you can control those investments and the transactions. And one big benefit, if you're interested in real estate in your retirement account, is that you can actually increase the buying power of the monies that you have in your account by using leverage. And we're going to go into some detail about the type of leverage that you will use if you're going to do that in your retirement plan. But you certainly can do that, and that allows you to use other people's money to fund an investment that you can actually be earning on in your retirement account. Now, I do want to talk a little bit about the guidelines for self-directing, and these actually apply to any retirement account. There are administrative requirements that must be fulfilled for all retirement accounts. Every year, an annual valuation of your account must be made, and it is reported to the IRS on that annual report, Form 5498. Detailed books and records of all of your transactions need to be maintained. So contributions, distributions, monies earned, assets held, their purchase price, earnings on those assets, expenses paid out of the account. So you have to keep detailed records for all of your transactions. Depending on what you own and where you own it, there are potentially some state filings that could come into play. And in some pretty rare instances, tax returns can come into play. And that's going to be that UBIT and UDFI that I mentioned earlier. So we will talk a little bit about that. It doesn't happen often, but it can happen. So we will mention it. Now, STC is a full service administrator. So we do fulfill all of these administrative requirements for our clients, with one exception. We cannot prepare the tax return if that comes into play, but what we will do is we can provide you, your tax preparer, with all the detailed documentations necessary for that tax return if that is something that comes in, that you do have to do. So we will help you with all of the other administrative requirements. Now, additionally to those administrative requirements, there are some things that you cannot do in a retirement account. There are some assets that are prohibited. And the first is life insurance contracts, with one exception. If you have a solo 401k plan, a life insurance contract is permitted in your retirement, in that retirement plan, but not in any others. Additionally, collectibles are also prohibited. So if there's a nice stamp collection that's very valuable, or a coin collection, a valued work of art, or some Persian rug, those may not be owned in a retirement account. Now, when I'm talking about coins, I am talking about coin collections. I'm not talking about precious metals. That is another class, and those are permissible in as they're certainly defined. So, but this, we're talking about a coin collection, something like that. So those are prohibited assets. And then there are some transactions that are prohibited. Now, your IRA, your retirement account, is given tax preferential treatment in the current time period because it is meant to benefit you when you retire. It is to encourage you to save for retirement and to benefit you with funds when you retire. So as you're engaging in transactions in your retirement plan, they do need to be for the benefit of the plan. They can't be to help out another investor with some kind of a transaction. There needs to be a viable benefit to your retirement plan. You cannot borrow money from your retirement plan. That is prohibited. You also cannot pledge your plan assets to secure a personal loan. That is prohibited. You also cannot utilize your personal credit or guarantee to obtain a loan for your retirement plan. Now, I did tell you that you could use leverage, you could get a loan, but it cannot be a personally guaranteed loan. In fact, it has to be a non-recourse loan, which we're going to talk about in detail, so I'll just mention that here. You cannot utilize your personal credit to get a loan for your retirement plan. You also cannot benefit any disqualified person with a transaction that you engage in your retirement account. So let's just take a quick look at who those persons are and then help you understand what we mean by that prohibition. So first off, you are a disqualified person to your retirement plan. And if you're married, that includes your spouse. So let's say, for example, you own a lovely vacation rental property in Myrtle Beach. Your retirement plan cannot purchase it from you. That would violate this disqualified person rule. There are other family members who are also disqualified persons, your ascendants. So that means your parents, your grandparents, your great-grandparents on up the line are disqualified persons. Also, your descendants. So that's your children, your grandchildren, your great-grandchildren, on down the line, also disqualified. However, lateral family members are not disqualified. So that would be your brothers and your sisters, your aunts and your uncles, your nieces and your nephews, your first, 12th cousins. None of those are disqualified parties. So let's go back to that vacation rental property. If your mother owns it, your retirement account cannot purchase it. If your son owns it, your retirement account cannot purchase it. But if your aunt and uncle own it, or your brother or sister own it, your retirement account could purchase it. So I mentioned these things not necessarily to make you become an expert in these rules. We'll help you with that. But just to help you think through when you're engaging in a transaction, who are the parties, and making sure that it is not a prohibited transaction because you're involving a disqualified person. There are also two entities that are disqualified. Any company if you're a majority shareholder, or any company if you're an officer, a director, or a highly compensated employee. So thinking about this as it relates to real estate, particularly investments, if you happen to be a real estate investor and you are operating your real estate investing business through a company and you are a majority shareholder or you're an officer, director, HCE, then anything that company owns also would be, you couldn't purchase your retirement account, could not purchase it from that company. So just some things to think about when you're thinking about who would be the parties to your transaction. Now, I do want to run through FTC's approach to servicing our clients. Again, we're a full-service, self-directed retirement account administrator. So we're going to set up for each of our clients' accounts a retirement account LLC structure. I'm going to define that a little more in a moment. We also have CPAs and attorneys available to answer your technical questions. We offer our clients unlimited guidance on transaction compliance, so complying with all those rules that I just went through. You don't have to be the expert. We will be your expert for you. We'll help you with that. We're going to handle all of that back office support, all those administrative requirements, the annual reports, keeping your books and records. We'll take care of all of that for you. We're going to actually maintain financial statements for your retirement account. So you will be able to see a statement of cash flow. You'll see a balance sheet. So you'll really be able to run your retirement account like a business, if you wish. We're going to supervise that regulatory reporting for you, and we will oversee the annual valuation. So really, basically, what we will do is we're going to provide all of that back office support and the expertise and knowledge of the rules and regulations for our clients so that you can go out and really just focus on finding the best investments for your retirement account. Let's talk a little bit more about that LLC structure. We set one of these up for each of our clients' accounts, and we do it for some very good reasons. One is it's going to give you maximum flexibility in structuring your transactions. Let's say, for example, you want to do a multi-party transaction. You have, in other words, multiple owners of this investment, not just your retirement account, and you want to use leverage. And let's say it's actually going to be a real estate property that you're going to rehab. So you're going to have some general contractor involvement. So structuring a transaction like that is easier when you have this LLC structure. We make it give you lots of flexibility with this. It does provide an additional layer of asset protection. It is a limited liability company, albeit a very specialized one. It's not a generic business LLC. It's articles of incorporation and its operating agreement are written and designed to be owned by a retirement account. So it's a very specialized kind of LLC. But it does give you that additional layer of asset protection. One of its maybe nicest benefits is that it gives you checkbook control over your retirement account. So that means that you can move quickly when you see a good investment opportunity. We can same day or next business day, if we have missed our bank's cutoff time, fund your transaction. Now, what we do is what we don't do is we don't give our clients the checkbook for their account. I have talked to some folks who have had the checkbook and they have unknowingly engaged in a prohibited transaction. And you have to unwind that transaction or face some severe penalties. So rather than do that, what we do is we look over your transaction and then can same day or next business day fund it for you. So it's like having protected checkbook control. You have our experts looking over your transaction first before you actually send the money. This structure also simplifies asset titling. It's a great feature if you're doing real estate transactions because you don't have to send or have sent to our offices the closing documents for a real estate transaction and then have somebody who might be out on vacation for the week have it sit in their inbox and not reviewing it. You can actually go to the closing for your real estate transaction. And you can sign on behalf of your LLC because you are the investment co-manager of this LLC that we will set up for you. So it simplifies asset titling. You can go to closing. Transfer of title is very straightforward. And another huge benefit is it eases pooling of funds or partnering with other funding sources. And in fact, you're going to be able to actually do some pooling or partnering, I should say, with otherwise disqualified persons as long as it's done correctly. So we'll talk a little bit more about that in a moment. So those are some of the benefits of the structure that we set up for each of our clients' accounts. So now let's get on to, okay, what kind of investments can I actually invest in? And again, you have a lot of opportunities. So I brought out onto your screen real estate transactions, different ones, single or multifamily homes. Again, vacation property. Now, I do need to give you a caveat here. If your retirement account invests in a vacation property, you can't personally use it because remember, you're a disqualified person to your retirement account. So it does strictly have to be an investment vacation property. Raw land, building lots, commercial buildings, real estate syndications. That would be when you get a group of investors together to perhaps invest in a multi-million-dollar development, something. So a syndication of investors put together for a real estate purchase. Tax liens. If you have a smaller amount in your retirement account, tax liens might be a good opportunity. They earn a very nice rate of interest in some locales, so you can do some research on that. Mortgages, you can actually buy real estate-backed mortgages. You can make loans and set the terms of those loans from your retirement funds. You can invest in private businesses, operating businesses. Now, one thing to keep in mind here, you can't work for that company. It must be a passive business investment. Can't even work for free for them. That would be, you do have to maintain that arm's length distance between them. You can invest in precious metals. What defines a precious metal has been set up by the rules, so we can help you understand what those are. But there are precious metal brokers that you can work with and own precious metals in an account with STC. Foreign currency, the Forex market, options, futures, and of course you could have a portion of your self-directed account in stocks, bonds, and mutual funds, and that could be a self-managed account if you like. So lots of opportunity in varying your assets in a self-directed account. Now, before we get into the actual details of real estate investing, let me just go through the steps that you would go through with STC in actually investing your money. So you come up with a transaction, an asset you want to purchase. I highly recommend, although it's optional, that you request from our client services department a review of your transaction. Have them look over the details, the structure, seller, what it is, where it is, all those things, so that if there's anything that is questionable, they can talk with you about that in advance. So it's not required, but you might as well use their services because that's what they're there for, and they are the experts. So you request that review of your transaction, and then you complete a request of transfer of funds. So this is one of our documents. You would fill that out with all the supporting documents necessary, send that to our client services department. You can fax it, email it, or mail it. That would take a little bit longer, so you probably want to do it electronically. And as soon as we get that, client services will review that transaction. If everything looks good, they don't have any questions about it, and hopefully they won't if you've reviewed it in advance with them, then they will process that transfer request, and the funds will be sent from the bank account that your retirement account LLC has access to directly to the seller. So you are not directly involved in that money. That money will come from the bank to the seller, and then the ownership of that asset will now be held by your retirement account. And we can do this process, and we can do that in a 24-hour turnaround time, unless it's over the weekend, of course. We have to operate by the bank's schedule. So that's how you would invest your fund. Now, let's look specifically at purchasing real estate. So your job is to locate the property that you want to invest in your retirement account and make an offer on that property. Now, again, we're the administrator, so we can't provide any type of recommendations about whether it's a good investment, or we can't give you any rental advice or resale guidance, that kind of thing. The offer must be in the name of the buyer. So in this case, it would be your IRA LLC's name. Now, if there are multiple buyers, if there are co-purchasers, then that offer must be in the names of those co-purchasers. Now, often you will need an escrow deposit. So then what we would need is a copy of the contract that shows the IRA LLC as the buyer and that request to transfer funds form that I mentioned. And if you're going to closing, we will need a copy of the estimated HUD or settlement statement showing, again, the IRA LLC as buyer and that requested transfer fund. And we do need that by 2 p.m. at the latest, Eastern time. We are in the Eastern time zone. Now, we really do suggest that you give us additional time in case there's an issue. We won't be able to wire out the funds if that name is incorrect on the settlement statement. If we have any questions, if there was a down payment that was made that didn't come from your retirement account. So it's always best to run that by us a few days in advance, just make sure that everything is all lined up. And then, of course, you can discuss our client services department will discuss the transaction with you if there's any questions. Now, typically, the disbursement of these funds needs to be guaranteed funds. So usually our clients request a wire transfer. There is a bank's official check. You can get an expedited delivery if you need that. You can work that out with our client services department. And then, as I mentioned earlier, one of the benefits of that IRA LLC is that you go to closing. You go to the settlement table and you can sign all of the closing documents. You know, we'll discuss it with you in advance. However, we don't need to approve and sign the documents. That is actually required by many custodians when the LLC structure is not used. They actually have to sign the documents. So it's a little different. Working with us, you can actually go to closing, you can sign the document. And you can just send us copies of those documents for your retirement account. And you can keep the original, you just send us the copies, yes. And I do want to mention, again, we're going to talk about it, you can use borrowed funds to purchase. Now, just to go in a little deeper here, it does need to be a non-recourse loan. And one other comment, oops, sorry, here we go. UBIT and UDFI can come into play when this happens. So I'm going to talk more about that in a moment. We won't go into detail here about that, but you can use borrowed funds purchase. Now, this I want to help you understand because it sounds a little opposite of what I said earlier. You can partner with anyone, including disqualified persons, at the inception of the purchase transaction. Now, I told you earlier that you could not do a direct transaction with these disqualified persons, but a partnership at the inception of the transaction is actually a transaction with the seller as opposed to with each other. So if you do a partnership with disqualified persons, then that ownership percentage between those parties can never change. So let's just do a little quick, easy example. Let's say your retirement account and your spouse's retirement account want to co-invest in something. Let's say it's going to be 50-50% investment, 50-50 each. That percentage can never change. So if you decide to improve that property, for example, then both of you have to pay for those improvements 50-50. All of the earnings are coming back into your account 50-50. That ownership percentage can never change. So all property expenses are paid pro rata. All property revenues are distributed pro rata. Now, some clients do like to set up a sub-LLC to own a particular property. And you can do that, but it doesn't change any of the rules relating to retirement account investing. So all the same rules are going to apply. We still have disqualified persons cannot do rehab, they can't do repairs, they can't be a tenant, a buyer, or a seller. So just all the rules have to be followed, but if you want to put a particular property in an LLC, you can do it. Now, when that LLC, that sub-LLC is set up, we will want to see the documents. We're going to check who owns that and what those ownership percentages are, and are they based on the monies that went into the LLC. So we're going to look that over to make sure that that doesn't violate any of the rules. So just keep in mind it can be done, and you can work with our client services department to understand how that can be accomplished. But all of the rules still apply. Still can't do any of those prohibited transactions or deal with disqualified persons. So now let's talk about this partnering that I said was made easier using our structure. You can partner with others. Oh, pardon me. There we go. And here I'm going to tell you, you can partner with yourself and your spouse and your family members. Again, you can do this if it's at the inception of the transaction. So let me tell you what I mean by that. Let's say yourself, your retirement account has money in it and you have some personal investing money. You can purchase something together. And again, it would be that maybe you own 40%, your retirement account owns 60%. You can partner with money outside of your retirement account and with these other related parties, as long as it's structured properly. Other investing colleagues, LLCs, investment syndications. You can partner with these types of entities. So let me just show you a schematic of what this would look like, or what it does look like. So if you're looking at the upper left, you'll see your current custodian. So this is where your money currently is. And let's say you decide you want to open an account with STC. So you would fill out some paperwork that would direct your current custodian to transfer or roll over money to our self-directed custodian. You'll also fill out some paperwork that will direct us, our operating department, to create an LLC in the state of your choice that is going to be owned by your retirement account. Now, once your money arrives at our custodian and your LLC is set up, then the money is going to move from the custodian into a bank account that your LLC has access to, and the ownership of that LLC is going to be held by the custodian, the membership interest of that LLC. Okay, so once that has all happened, now you're ready to start investing. And in this case, your retirement account has 3 investments. Investment number 1 is a tax lien investment, wholly owned by your plan. Investment number 2, you purchase property for rehab and rental, wholly owned by your retirement plan. Investment number 3 is different. Your retirement plan is one of 4 investors. You're invested with your father, your daughter, and your personal funds. You pooled funds with these other investors to purchase a small retail center. And that is an allowable, viable transaction as long as you co-invest at the inception of the purchase transaction and as long as your ownership percentages never change throughout the life of the transaction. So this is a very interesting way to invest, and if you have more interest in that, of course, we can help you with how to make sure your transaction is structured properly in order to accomplish that. Now, I do want to cover and discuss the topic of non-recourse loans. This is using borrowed funds to purchase real estate in your retirement account. So what is a non-recourse loan? It simply means it's more like a business loan, not personally secured. It means that the security instruments, the notes, the mortgages, allow no recourse against the individual account holder or the balance in your retirement account. The only recourse the lender has in the case of a default is the property itself. Your retirement account isn't a person, it doesn't have a job, so there's no income or employment verification for this. This is actually your retirement account getting the loan. So some basic industry standards. Again, there are a number of non-recourse lenders out there. This has become pretty commonplace in retirement account investing, so you can do your due diligence research on the internet and find some non-recourse lenders to compare. But generally, industry standards require documentation, a loan application, purchase and sale contract. They will want to see your IRA statement, see how much money you have there or whatever retirement account type you have. They'll want an appraisal of the property. If it's a rental, they'll want to see a rent roll. Loan guidelines, maximum loan to value is probably going to be 70%. So you're going to have to put down a larger down payment on a non-recourse loan. Maximum term could be 20 to 30 years. We have also seen ARMs, adjustable rate mortgages, 3-1, 5-1, 7-1, that's possible. They will be looking for an income to expense ratio of probably at least 1.25, and they will likely require you to carry 3 to 6 months of reserves in your retirement account. Now, let me just explain briefly what that is. Okay, so this is a property, you're getting a loan on it. Properties have things like real estate taxes. They might have something go wrong with them that you have to repair. So remembering that it's your retirement account that is owning this property, your retirement account has to pay for these things. So the lender is going to want to see that you have some cash reserves in your retirement account to cover things like property taxes or whatever might come up that needs to be covered on this property. So that's what the reserves will be about. And of course, you'll need to discuss that with the lender and see what their particular terms are. Eligible and ineligible properties. Eligible, single family houses, some condos would have to check, 2 to 4 plexes, multifamily housing, small apartment buildings, retail, office, warehouse, all of those are eligible for non-recourse loans. Things that are not, mobile homes, timeshares, condo hotels, those have become pretty popular. Residences with 5 or more acres, farms, those are generally ineligible. So just to keep in mind as you're doing your research on the type of investment you're looking at and considering a non-recourse loan. Now, taxes. Not one of my favorite topics, but I do want you to understand how this could relate to an investment in your retirement account. UBIT is unrelated business income tax, and UDFI is a subset of that, which is unrelated debt financed income, which is taxable. So unrelated debt financed income. So we were just talking about getting a loan for your retirement account, getting a loan. So that is going to be debt financing a property that hopefully is going to earn income. Say it was a rental property. So the IRS decided that this applied to retirement accounts. It really was kind of set up originally to apply to, UBIT was set up to apply to companies that were engaging in income producing activities that didn't relate to their nonprofit purpose. So, for instance, a university, public university that's nonprofit, but holds rock concerts in their stadium, generates income from that. That's really unrelated to the business of education that the college is in. So that's kind of where this came from, and the IRS decided it also applied to retirement accounts. So any income that is generated from an asset that was purchased using financing. Now, UDFI is based on net income of the property, so that means you get to deduct all of the expenses, and the first $1,000 is exempt, and only the percentage of taxable income is based on the ratio of debt on the property. So, for example, if the property is 50% debt financed, then only 50% of the income can even be subject to this tax. This will also apply if you sell the debt financed property and there's been outstanding debt anytime in the 12 months prior to the sale. And then in that case, then that will also come into play in the proceeds of the sale as well. Now, I have talked to some real estate investors who are only able to do the transaction if they debt finance the property. And they're like, oh, no, I don't want to pay any taxes from my retirement account. But they might be missing out on an opportunity that really could be a good tax earning opportunity if they kind of ran the numbers and saw what it was really going to come out to be, what the taxes really were. So let's take a look at an example. So this is an example of a rental investment. And we're going to make it easy. This is a rental property that's 50% debt financed. So let's say it was a $200,000 house in a college town near a college campus. You debt financed $100,000 and you paid $100,000 from your retirement account. So 50% debt finance. Your annual net rental income from this investment is $12,000. $1,000 per month. That's after all of your expenses, all your taxes, everything is paid. This property is earning $1,000 a month for you. So the income that's going to be subject to UDFI is $5,000. And we calculate that by taking the $12,000, that's the total net rental, but this property is only 50% debt finance, so only 50% of that $12,000 can be subject to this tax. And I also told you that the first $1,000 was tax exempt. So that's where we get this. $6,000 is 50% of $12,000 minus $1,000 leaves you only $5,000 is subject to the UDFI tax. Now it is taxable at the trust tax rate, and the trust tax rate is a graduated rate. And for 2023, that rate goes from 10% up to 37%. So I did the calculation for 2023, and the taxes on this $5,000 would be $794, which means that your net income from this property is $11,206. So for your $1,000 investment, because remember $100,000 was debt finance, you want to ask yourself, is $11,000 a good return on my investment? So you might want to look at this kind of a calculation with your tax advisor when you're considering, maybe you do want to get a loan for a property that you could not otherwise afford. Might be something to consider. So unrelated debt finance income is taxable at the trust tax rate. It is reported to the IRS on Form 990T, and this tax must be paid from the retirement account. So back to that example, you had $12,000 net income. So that $794 has to come out of your retirement account, because that is who the tax is due from. So it must be paid from the retirement account, and of course we advise you to talk with your tax advisor. They will be able to assist you with this. Okay, so now we have time for Q&A. I did get some questions in advance. If you have questions, please do type those into my question box, and I'm going to open that up so that I can see that, and I will look for your questions there. So give me just a moment to get to the ones. Oh, and while I'm doing that, let me also put up on the screen our contact information so that you can copy that down if you like. So I'll answer your questions now, but if you have some questions after the fact or want to talk, our website, STC IRA, has a lot of detailed information on it, talks about different types of investments, also has some clients talking there about the investments that they've done, which might spark some ideas for you. Our corporate office number is there, and my direct email address is there. So you can also contact me via email if you like. All right. So back to looking at these questions. Okay, I do think I covered this one. She says, I'm hoping you'll cover how to partner with yourself or family friends to use some self-directed money and some from other sources. So hopefully I made that clear to you that you can partner as long as that is done at the inception of the transaction. And our client, you can talk to our client services department before you put a down payment down, before you title anything, so we can make sure that you have all of those documents written properly. But you certainly can do that as long as it's done properly. Okay, can you purchase additional interest in a property that you are already invested in? Okay, so I'm going to assume that means that you personally are already invested in. And so unfortunately, the answer to that question is no, you can't, because if you're personally invested in it already, remember that you are a disqualified person, so you can't do a direct transaction with something that you are already invested in. Now, if it's a new investment, then you could partner with yourself. Okay, and one just popped up on my screen. If I have a furnished rental property, how do I purchase furniture and supplies? Would they all need to be online ACH from my IRA checking account? How that would work, you would run that through our client services department. You would actually request checks from us. I mean, the checks would come from the bank account that your LLC has access to. So it's coming out of your LLC, written to the vendor. And if it needs to be ACH, you can work that out to see if they can accommodate that. But you would basically be submitting a request to expend money from your account and who to send it to and what it's for and where to send it. So you would work out those details of purchasing furniture and supplies or whatever you want in your rental property for your renters. Okay, let's see, another question came in. Okay, so when I talked about annual maximum allowable contributions, I said you could contribute $6,500 or $7,500 into a traditional or a Roth IRA, and I said that had to come from earned income. So let me just define if someone has a question about what that means. So you can get earned income by working for somebody who pays you, and you get a W-2, or if you own or run a business or farm. So taxable earned income would include wages, salaries, tips, any other kind of taxable employee pay. Sometimes union strike benefits, long-term disability benefits are also included in earned income. Net earnings from self-employment. So if you own or operate a business or a farm, ministers, member of a religious order, there's some special information for you. So things that are not earned income are retirement income, interest and dividends from investments, Social Security, unemployment benefits. Those are not earned income. Alimony, child support. So just to help you clarify, when you work for somebody who pays you or you have a business, and then a couple of those other exceptions, that's where earned income comes from and what you can contribute from. Okay. If I want to purchase a bank-owned house, they often require verification of funds. How would I verify funds that are in my self-directed IRA? Great question. You would talk to our client services department and they can prepare a letter for you to the party that you want it sent to. You can tell them the dollar amount of funds that you want them to verify up to the full amount in your account. Let's say you've got $1 million in your account, you might not want the bank to know that you have $1 million. So you might only want verified up to the price you're willing to pay. But we can create a verification of funds letter for you. Can I provide startup capital for a new business, a retail clothing operation, or an auto repair shop? Startup capital. Yes, if it's a disqualified person isn't involved in the transaction, you should be able to. Now, what you will want to keep in mind, though, that this could trigger UBIT, unrelated business income tax. We're not talking about a loan here now, but we're talking about business income. So that is something you might want to talk with our client services department and your tax provider, preparer, if you have a tax expert that can help you with that. But it shouldn't be a problem to invest in it. It just could trigger UBIT. Okay, if I want to put IRA money into a self-managed stock brokerage account, can I actively trade in that account with IRA funds? Yes, actually you can, and we do have clients who do this, who might be in between investments, like perhaps they had a property, they sold it, now all those proceeds are back in their retirement account. They're looking for their next investment, and they don't want to leave those funds just sitting there earning very little interest in an escrow account. So yes, you can open a brokerage account. It does need to be a business brokerage account. It needs to be in the name of your IRA LLC. Can't be you personally. And we will send the funds that you direct us to that account. You can trade it. We will ask you to send us your monthly statement so that we can confirm that you haven't taken any distributions from that account. You haven't taken any money out or put any money in personally, because it's owned by your retirement account. Those monies, contributions, monies into it need to flow through your retirement account, and distributions out of it need to flow through your retirement account. So but we can help you understand that. But yes, you certainly can, and then you can do your online trading in that account. Okay, I already answered that question. Let's see. Oh, now this is a little, we didn't actually talk about this, but somebody has asked the question. I can just do a couple more questions. How are taxes calculated on assets that are converted to a Roth account? Okay, first let me back up and say, I mentioned that Roth monies were post-tax when you made contributions, and that then your earnings were basically earned tax-free if they were then taken down the road in a qualified distribution. So some people choose to convert monies in, say, a traditional IRA into a Roth IRA. When you do that, monies in a traditional IRA, contributions were pre-tax, so they weren't taxed. So now that money is going into a Roth account, there's going to be a tax consequence. So now back to the question, how are taxes calculated on assets that are converted? So let's say you're moving a property. Let's say it's a piece of real estate from a traditional into a Roth IRA. You're going to have to pay taxes on that property. And the taxes are going to be calculated on the market value of the property as of the date of the conversion. So there's going to need to be an appraisal done on that date, and that's going to be the value that's going to be included in your taxable income for that year. Now that property is going to reside in your Roth account. Taxes were paid on it, so now everything it's earning will be earned tax-free in a qualified distribution. And that will be taxable at your ordinary income tax rate when you pay your income taxes that year. Oh gosh, my time is up. This has been great. I've enjoyed your questions and the time together. If you have additional questions, please get in touch, phone, email, and I hope that perhaps you will join us next time. Thanks so much. Good night.